Gareth Woodham, welcome to Property Insights, mate.
Thank you, Mark.
And you're a director, or you have a franchise with Suburbanite.
Yep.
Which is
correct,
my good friend Anna Porter's business.
Yes.
Well, your business, but you're a franchise of her franchisor business. And you're also a property valuer.
Yes.
Which is quite interesting at the moment.
Yeah, well, it's great. I've got my own private practice, specialising primarily in family law. So when people are getting divorced, they need to split up the assets, and so provide that to the lawyers and the courts.
So that's in terms of valuations?
Yes.
What about in terms of, well, give us a rundown quickly what Suburbanite does.
Suburbanite, they buy investment property for clients all over the country. They specifically work with investors, and it's about identifying, first of all, what the client's looking for and what they're trying to achieve out of investing in property. They made a decision that they want to invest in property, and then it's guiding them through that process, understanding their budget, their parameters, their personal risk profile, because you don't want anyone to do anything that they're not comfortable with, but you do need to guide them to make sure that they are on the right path for what they actually want, not what they think or that they might have heard around the traps. So it's about educating people all the way and then carrying them through that.
Okay, let me just build a scenario. Let's say I'm a rugby league player and I'm on, I know, 400 grand a year, so I'm a mid-level rugby league player, playing first grade, one of the NRL clubs. Me and my wife, and I have one child, we want to build up a portfolio for the day where I retire, which could be somewhere between 30 and 35, after which I'm probably going to struggle to earn an income because I don't have a trade. So what are you going to say to me?
Oh, well, Mark, it's a really good idea to be thinking about investing and to secure that future, because you acknowledge that you're not going to have that income in the future. You've got a good solid income now. So we would be very much suggesting you'd be looking to build a portfolio, multiple properties, with a focus on capital growth now. You want to build your wealth now, so that, as you mentioned, you want to retire later and you want to live off that rent later. So you need to build wealth now to build income later. You're not talking about building income now because you've got the income. So we'll be looking for properties, and we create a strategy that would find properties around the country, looking at areas that are in the ascent on their cycle. As you know, property in Australia tends to move in cycles. It'll grow, it'll reach its peak, it'll come off a little bit, and then it'll flatten out for a while and then return into that growth. So over the long term, wherever you start on that cycle, they do tend to move up. But it is important at this point you choose areas that are in the ascent, so that you can capture that growth. And if you're still earning money in 5 or 6 years, you're still earning your good money, then you would take some leverage out of leverage those properties, some of that growth, and use that to
Let's
apply
just,
some more.
because we'll come back to that bit,
Okay.
the leverage bit. In other words, use the equity. So between here and year 5,
Yep.
my plan is maybe to buy 5 properties. Yeah.
Yep.
And I've heard Anna Porter, who's the head franchisor, the creator of your business, Suburbanites. I've heard her say that if you buy in regional areas, your rental yield will be usually much higher than if you buy in a metropolitan area, but the capital growth, the growth in the value of the property, will be less.
Yes.
Is that still the same?
No,
No.
not right now. So after the pandemic, with the pandemic, we've had, as you've seen in your business, there's been property price growth across the board. People have been very much focused on houses in that, because they've made decisions about how they like to live, because they want to have a bit more space, and also with a big push for working from home, where everybody had to work from home. So people could reset and have a real think about that, and they were looking at different lifestyles, so they could move away from the hustle and bustle of the city and move somewhere that is regional. And so we've seen massive price increases. I did a valuation 2 weeks ago in Coffs Harbour. They've had 35% increase in dwelling prices over the past 12 months. I was in Orange last week, and they've had just over 30% increase in property prices in 12 months. So these are higher than the median house price increases in Sydney and Melbourne and Brisbane. Where the concern is, they've had this big leap up in price, which is atypical for those markets. Yes, I agree that they've always had very strong rental yields, but even when we're talking about Hobart having the most unaffordable rental market in Australia relative to incomes, these areas have really pushed the boundaries of what people can afford to pay for rent. So everybody has heard about what's happening in Byron Bay. All the people that live there can't afford to live there anymore, and it's all the people from Sydney buying their second or third home up there. So the rental yields are not reflecting the long-term average in those areas. So at present time, we're definitely not suggesting to buy in regional areas for rental yield. where we've pulled back from those markets because they've had such strong growth, and we need to wait for the rents to be able to catch up so that you can start to see a rental return that does. Remember, a return on any investment is a reflection of the risk associated with that investment. If you have a lower rental return, it is acknowledging that you have less risk with that investment. And when you're in a capital city, well-located property, a detached house, it's going to have a very low rental yield. So in Sydney, it's not unusual to see sub 2% rental returns for detached houses, where in regional areas, you typically, in the past, you're expecting 4 or 5% plus. Whereas, or even higher, but you're not getting that rental yield at the moment because property prices have escalated so quickly, just over the last 18 months. So now looking for capital growth, you still stick to your capital cities, but you need to find a different option if you're looking for yield. The yields are good in, say, southeast Queensland, so Brisbane and Sunshine Coast are getting up around the 4% for houses. Adelaide's doing terrifically. Perth's been a real surprise lately, getting over 5% on just modest, 30-year-old houses on reasonable blocks of land not too far out from the CBD. So there are opportunities for yield in capital cities now, less so in Sydney and Melbourne, but definitely you'd be looking to focus on capital growth to start your portfolio.
Okay, so I got 400 grand, and I don't have a house. I'm just renting a place here in Sydney with my wife and kid. Playing football on the weekends, training every day of the week, really hard, and hopefully I'll play for Australia. And as you said, as I said earlier, I've got like another good sort of 8 years left on my contracts. Where would you say I should look at buying my first property? Should I be looking? You did mention that I should be looking at capital growth as opposed to rental yields. In other words, have some negative gearing. I'll borrow $1 million, and then I won't earn enough rent to pay that off. But I've got good income, so it doesn't matter. Where would you sort of direct me first? I'm not saying don't have to pick the street in the suburb, but where would you say? Would you say Coffs Harbour, or are you going to say Sydney Metro or Adelaide Metro? Where would you say?
Straight off the bat, I'd be really comfortable with southeast Queensland, specifically Brisbane and Sunshine Coast. The Gold Coast has been going great, but I like the Brisbane and Sunshine Coast for capital growth. I also like Adelaide. That's terrific. If you're and starting out on your journey, you're a bit bolder. I'd be pretty comfortable with Perth too.
Why are you comfortable with Brisbane and say, well, that's southeast Queensland, Brisbane and Sunshine Coast? Why are you comfortable with that, and why are you comfortable with Adelaide? What's the data telling you? What are the parameters out there that make you comfortable relative to everywhere else?
The data is telling me that there are people moving to those locations, and the other parameters are the activity at those open for inspections, at the bids, the offers that are being made on the first weekend that a property is available. You go to Adelaide and you put just a decent family home on the market, I'll get 30 plus written offers on the first weekend. So that means there's a lot of depth in the market for those properties. So where in Sydney we're seeing 2 or 3 registered bidders or 2 active bidders at an auction, you'll have 30 plus written offers on the first weekend on a house in Adelaide, 20 to 30 written offers the first weekend on a house in Brisbane.
And Noosa? Is that Sunshine Coast? Is that the same?
No, Sunshine Coast, we're talking around the sort of the Maroochydore. That sort of area. But yeah, Noosa, although Noosa's, you're starting to lack the affordability, which can support owner-occupiers. You want to be in a market where owner-occupiers, that's the other thing that we really focus on, owner-occupiers. They drive a market through good times and bad. Someone's always going to have somewhere to live, and when things get a bit tough, they don't tip out.
Right.
Investors will tip out of a market when things get a bit grim.
So is the reason why Adelaide and Brisbane are getting much greater demand or much greater attendance at first day of openings or whatever it is, the period of inspection, is that because people from Sydney are looking at those places because they're more affordable, or is it because people are trying to move out of Melbourne and Sydney to go up and live up there, or what's that dynamic going on there?
you've answered both those questions. So Sunshine Coast, Brisbane, it is a lifestyle change. So there's plenty of employment opportunities, and it is an easier pace of life, and we've got a nice climate, and it does offer everything that you need to live. Adelaide is very much driven by affordability, so it is not a very tough decision to buy a $600,000 investment property in Adelaide.
A house?
Yeah, for a house. So whereas to buy a house in Sydney, you're looking at to get in a reasonable area, you're looking at about $1.2 million, and that's a reasonable entry price for Sydney for a house. Otherwise, you're getting in less desirable suburbs, and so you've got all other concerns there.
So, and you're saying houses, by the way. We're not talking about the portfolio we're trying to build here. For me, is a single dwelling.
I'm looking. I've in all my 23 years as a property valuer, a capital growth over any period is much more focused on houses. The land component is the part of an asset that appreciates. The built component is what depreciates.
And how much of that is that decision that you're suggesting for me is based, particularly when it comes to Brisbane, is based on the fact that a lot of the immigration out of Sydney, Melbourne, particularly Melbourne, into places like Sunshine Coast is for people to get a lifestyle. In other words, house, backyard. If we get locked down, we don't have to get stuck in a unit. I can sell down my unit in Victoria or Sydney, and I can probably trade it into a house in Brisbane or the Sunshine Coast. How much is that a big part of it?
It has been a big driver of the lifestyle. I don't think anyone believes there will be another lockdown, but when people's eyes have been opened to what they can do, and it's not all about just having the grind to live in something that's compact, because they start to appreciate the value of that space. But yet it is a lifestyle that those areas have developed a lot more. So 20 years ago, it was lacking a lot of the cultural and other services that people appreciate from living in a major city, and that acknowledgement that you can cash out and clear your mortgage. So you can, even if you had a reasonable house in the eastern suburbs of Melbourne, 20 k's out, you might sell it for $1.5 million, and you pay off your $500,000 mortgage that you had because you bought it 10 years ago, and you buy a house in Sunshine Coast for $1 million.
So your business, Suburbanites, it's obviously data driven. I mean, you get a lot of data out of the head office, and when you get a whole group of different franchisees doing transactions for their customers or clients, you're getting more data about where people are going, why they're going there. How important is data to a buyer? Say me, as I said, I'm the football player. I don't have my hand on the tiller when it comes to data. I mean, I'm really interested in playing footy. Today, because once upon a time you say, oh, I'll go buy a place, have a look around, look at the newspaper, it looks nice, go and have a look and let's buy it. Today, it's much more data driven, much more intellect around it.
Yep.
How important is that, do you think, for a buyer?
For the buyer, like, it does depend on the buyer. You might have a buyer, like, you're a football player, so you probably don't have the same engineer mindset that someone likes to look at spreadsheets all day. So horses for courses on the data. For us, the data is important because it helps us drive where we're going to send somebody. But what's far more important than the data is having the ability to select the right property within that market. Just because I say Sunshine Coast doesn't mean we all get on a plane or get on realestate.com and buy whatever we can find, because that is a great place to buy, because that is how so many mistakes are made. If you don't select the right property in those markets, if you're just doing it for FOMO and you're going to, everyone else is doing it, you will make mistakes. It's very much about the right property for that market. So it has to be the right property that's suited to that market. It has to be without compromise, because, as I mentioned, property moves in cycles, and when it's a downturn on that cycle, it's not a homogeneous fall in values. You have properties that hold their own, properties that creep up a little bit, and some that drop 30%. Just simply, if you've got 50 houses for sale and there's 5 buyers in that suburb, they're going to pick the 5 best houses. The only way you can attract someone to your house, if it's not that good, is to drop the price. So it is definitely about the property selection. The data is important to find the location, but it's the property selection that makes the difference on the investment performance.
I once heard Anna Porter say that when it comes to buying in Sydney Metro, anything further than 40 minutes out of the city, was it as attractive as anything within 40 minutes from the city? Is that still a bit of criteria that you guys look at in Metro?
We definitely look at commuting times. So that's a big criteria for us, and different cities have different levels of what's acceptable. So Sydney and Melbourne, we readily accept 40 to an hour as a commute time. Once you're getting beyond that, then it doesn't become an aspirational area. It can be a stepping stone to somewhere else. You still got to have somewhere to live, and you've got to live where you can afford. So if you're buying a house to live in for 10 years, it might not be your forever location. So it is important to be proximate in terms of a travel time that's acceptable to your location. People aren't that happy to commute an hour in Adelaide. No one would commute an hour in Hobart. You almost get to Launceston. So we're not. It's about finding the commuting time that works in that location, and they do perform better when you're within that acceptable commuting distance.
So what would be the commuting time that's acceptable in Sydney, for example?
I'd say an hour, yeah.
And Brisbane?
40
minutes.
40 minutes.
Melbourne?
Yeah. An hour.
An hour. Adelaide?
30.
30 minutes.
Yep.
And Hobart?
15.
15 minutes, okay.
Yeah.
I guess Perth too. I can't leave Perth
15,
out.
20 minutes.
15, 20 minutes.
Yeah.
That's interesting. So one of the things bothers me a little bit about building a portfolio as a footy player, I don't want to have them all in New South Wales because I don't have to get over the land tax threshold.
Absolutely.
So if I buy one in Sydney, one in New South Wales, one in Queensland, one in Victoria, one in Adelaide, do they add up all my values so that I pay a really heap of land tax, or do I sort of somehow get around the land tax issue?
Absolutely not. Land tax is a state-based tax, and your threshold resets with each state. The only difference is the ACT. For investors, there's a zero threshold for property investors, so you will pay land tax from the first dollar of land value.
What happens if it's my principal place of residence?
You don't pay land tax.
Right. And can I select a place as my principal place of residence even though I rent it out?
No.
I actually got to live there.
Yes.
In the ACT.
Oh, if you want it to be land tax exempt, yes, you would have to live in it.
And who checks?
They'll find out.
They'll find. Okay.
Yeah.
Okay.
Especially with your profile as a football player, mate.
Okay. So when it comes to not avoiding land tax, but sort of keeping
Mitigating
land
it.
tax under control, would you recommend to me that I buy in different states?
Completely. You would diversify, not just for land tax. Land tax is a consideration, but also to diversify in different markets so you can capture the growth at different parts of the cycle. So your portfolio can always be on the ascent at some point.
Yeah, because sometimes some states go up, some states don't go
they
up.
flatten out, and so you won't be able to. You might hold it for 2 years and you don't see much capital growth, so you can't. That will pause your growth of your portfolio. You won't be able to capture any equity out of that to buy your next one. But if you've got a diversified portfolio, you can keep moving forward.
Right. So, in terms of period that I should be looking at, so as I mentioned, I've got an 8-year. I reckon I've got 8 years left in me in terms of playing footy, guaranteed, subject to me not getting injured. Over that 8-year period, are you saying what's the time that I should be looking at holding these properties? Should I be thinking I'll get a buy and sell in 2 years, or how's it all work?
If you're buying to invest and your motivation is to build your wealth and to retire on, I would. I always guide people that if we buy a good property, you don't sell it.
Ever?
No, not unless you have to. If your goal is to buy 2 investment properties so you can liquidate them and buy your dream house in Sydney, then yes, that's your target, is to sell them. And I would say that you need to have a time frame of at least 5 years, because you've got your ingoing and outgoing costs that are not inconsiderate. So we've got to take account for that. But if you're buying good investment property, you buy and hold.
Yeah. So you're saying buy with the view to hold it forever.
Yep.
It's like playing Monopoly, because I just got to hold it forever, never ever sell it.
If it's good property, why would you?
No, 100%. And then in terms of, let's say I got myself over a 5-year period, I bought one a year.
Yep.
For argument's sake, it's not a bad goal. I've got 5 properties: one in Sydney, Melbourne, Adelaide, Brisbane, one else somewhere else. At what point do I start looking at the equity in those properties to then drag some equity out of those properties to go and buy somewhere else?
I would normally coach people to say expect something after 2 years. You don't expect phenomenal, like there has been magnificent equity growth in the last couple of years, but normally I was saying 2 years and you can start to revalue your portfolio and see where those opportunities are. But I would be, the expectation, to manage expectations, I would say 2 years as your minimum.
And we've seen phenomenal growth over the last couple of years. What are you guys at Suburbanite sort of looking towards in terms of growth on average in the property market across all of Australia over the next, say, 12 months and 2 years? What, like 5% return, 10% return? What are you looking at in terms of capital growth?
There's not a straight line on that at all. So in different markets, I would still be expecting double-digit growth in South Australia, and Perth to rise into double-digit growth. I think it was about 9% over the past 12 months to a month ago. I would expect Sydney. There's all the evidence in Sydney at the moment is that there is a decline. I looked at a property that sold in April this year in Oyster Bay, down in the Sutherland Shire. It sold for 1.6 million. It was purchased in October 2021 for 1.655. So it dropped $55,000 just in that short period of time. Likewise in the eastern suburbs, I recently valued a townhouse, the identical townhouse next door, Unit 8 and Unit 9, one sold for $60,000 less between December and February this year. That's a couple of examples, but where the evidence lies, I touched on it earlier, the number of active bidders at auctions has really thinned out. And so I don't see massive declines. There will be terrific examples on a current affair of people who have lost 30% of the value of their property, but they are extreme examples because they're heavily compromised properties. But I do see growth to be maintained in Southeast Queensland, definitely growth in South Australia and WA in the capital cities. Melbourne had a bit of a rough year last year, and it has still got that issue of affordability. But if you compare Melbourne with Canberra, Canberra had a median dwelling price of 1.1 million, and Melbourne had 1 million. So Canberra had accelerated beyond Melbourne. Smaller market, highest average household income, highest level of household education. So there's different drivers in that market, and it is a very small market, 340,000 people. But they don't have enough houses at this point in time.
As a valuer, what are the two things that someone could do to improve the value of their property? I mean, like, is it fix the kitchen, fix the bathroom, like build a cubby house down the back? I mean, put a carport in. What?
I get asked this question so many times, and my answer is always the same. It is make it the best version of what it is. So if you've got a 50-year-old 3-bedroom, 1-bathroom house, make it a neat version of that. If you've got 5-bedroom with a granny flat, make sure it performs well at that. If it's completely run down, then it more or less represents land value. Well, then look at it like that, and it is a development site. But if it's just a bit tired, just make it fresh. Don't try and make it into something that it's not, because that becomes, and today with construction costs, steel's up 40%, timber's up 30%, trades are very hard to get. So to embark on a serious project, you've really got to see that opportunity. You don't see that opportunity if you're trying to remodel a 3-bedroom house and make it into something off the block or something like that.
It's still a 3-bedroom house.
It's still a 3-bedroom house, so just make it a great version of that. Tidy it up so people, when they walk in, they feel really comfortable with it, and you will achieve your best price. That's why agents will always there'll always be a budget to style a house, just to make it the best version. They might recommend just paint it, just give it a freshen up, but they don't say to gut the place and start again. Even if it's a 60-year-old 2-bedroom unit, they'll just say, get the furniture out, give it a clean, put in some nice rental furniture, just make it a great version of what it is.
That's a great answer. And because often I hear people say, I've got to put up a new kitchen and bathroom, I'm going to flip it. But I often say to people, well, yeah, but what about the new kitchen you put in? The person who comes in doesn't like it. Not everyone likes your style. And flipping places is okay in a rising market, but the reason you flipped it for a profit is because the market was rising, not because of the great kitchen you put in. Would that be correct?
My own personal experience, Mark, on my first house, I spent 12 months renovating it with my bare hands, and the market was moving forward. This was in 2001, 2002.
How much did you pay for it?
$297,000.
Where was it?
Oatley.
Oatley, yeah, in Sydney, yep.
Sold it a couple of years later with brand new kitchen. Yeah, like as I said, just made it a really nice version of itself. Brand new kitchen, brand new bathroom, and paint and carpet and everything. People that bought it didn't move in it for 2 months because they spent 2 months gutting the whole place and doing it again. These were the timber windows that I'd sanded by hand, the skirting boards, painted every room myself. So that it was fine, but it just wasn't to their taste, and so
You wasted your money.
waste my time.
Yeah, you waste money and time, and you probably could have just tidied it up, made it really nice and presentable.
Could have thrown it. Oh, it was pretty rough, but I could have thrown a coat of paint over it, and that would have, and mowed the lawns.
Did you make a profit?
Yeah.
You made it earn anyway.
Yeah, but I was young at that point, and I would have made profit with my eyes closed.
Gareth, thanks very much. It was awesome.
No worries, mate.
Great
Thank you.
advice.
Cheers. Thank you.